Welcome back to another explainer. Look, if you're focused on figuring out how the world's money is actually tracked, measured, and reported, you are in exactly the right place today. We're tackling a foundational concept in international business, the two distinct financial languages of the world. On one side, we've got US GAAP, and on the other, IFRS. Understanding how these two frameworks interact, where they actually agree, and where they fundamentally clash, that is absolute table stakes for understanding global finance.
Okay, let's dive into this. I want you to picture two completely identical companies. I mean, they sell the exact same products, they have the exact same overhead, and they operate in the exact same economic environment. Yet, at the end of the year, you look at their balance sheets and income statements, and they look completely different. One is reporting massive asset wealth, the other isn't. One shows way higher profits, the other is much lower. How is that even possible? Well, it comes down entirely to the accounting rulebook they're forced to use. It's not magic, it's methodology. Section 1. The Financial Language Divide, US GAAP versus IFRS. So let's look at the foundational philosophy that really separates these two systems. At the highest level, the balance sheet totally sets the tone. US GAAP, which is the standard in the United States, obviously, is notoriously rules-based. It demands a highly prescriptive presentation. It basically tells you exactly where every single thing must go. IFRS, which is used by much of the rest of the world, leans into a more principles-based approach, making it inherently more flexible. And this isn't just some administrative quirk, It's a fundamental difference in how financial transparency is philosophically defined.
Let's move to Section 2 and see how this builds, where the rules align, highly converged areas.
Now, before we get into the heavy disagreements, we gotta look at the harmony. The accounting world has literally spent years trying to merge these two languages, and honestly, they scored a massive victory when it comes to revenue recognition. Whether a company is using ASC 606 under US GAAP or IFRS 15 under the international rules, the framework is highly converged. Both systems now use the exact same 5-step model to figure out when and how revenue is officially recognized on the books. It's this rare, beautiful moment of total global agreement.
And that harmony actually extends to a few other crucial areas too. If you're calculating overall earnings per share, EPS, the rules are highly converged. When you're determining fair value, both systems use the exact same levels 1 through 3 hierarchy. And if a company has borrowing costs, both US GAAP and IFRS absolutely require the capitalization of those costs. That means you record them as an asset rather than taking an immediate hit as an expense.
Section 3. The Great Asset Debate, Valuing What You Own.
All right, here's where that global harmony comes to a screeching halt. Let's start with inventory. Both frameworks are totally fine with companies using the FIFO method and the weighted average method. But check out that red X for LIFO. Last in, first out is strictly a US GAAP tool. IFRS explicitly bans it, no way around it. And this is a massive deal, because using LIFO during periods of inflation can significantly lower tax burdens. It gives US companies a unique strategic lever that international companies simply cannot pull.
Now, what's really interesting about this slide is how things diverge during market corrections. Notice the brick wall on the left versus the trampoline on the right. Let's say a company writes down the value of its inventory, but then the market recovers. Under US GAAP, bam, you hit a brick wall. You literally cannot reverse that write-down. But under IFRS, you hit the trampoline. Reversal is totally allowed, letting an IFRS company bounce back its inventory values on paper, while the US GAAP company is just stuck with that initial pessimistic valuation forever.
And this gap gets even wider when we look at property, plant, and equipment, or PPE. For subsequent measurement, US GAAP basically says historical cost only. So if you bought a building 40 years ago, it essentially just sits on your balance sheet based on that really old cost. But IFRS allows either the cost model or a revaluation model. That means an IFRS company's balance sheet might look significantly richer because they're actually allowed to revalue their real estate to reflect current market realities. GAAP, by design, kind of hides that wealth.
And what about the assets you literally can't touch? Intangible development costs. Here we see a really stark contrast in pacing and future value recognition. US GAAP generally says, expense it, right now. Take the hit on your income statement immediately. IFRS takes a totally different path. It says, capitalize it. Well, if you meet certain qualifications and criteria, you must capitalize those development costs. So once again, IFRS allows a company to build up the asset side of the balance sheet in a way that GAAP just flat out rejects.
There are just a few other structural asset differences you'll want to commit to memory. Quick hits here. Take component depreciation, for example. Strictly required under IFRS, totally optional under US GAAP. Then there's investment property. IFRS has a dedicated standard for this. IAS 40, which even allows for a fair value model. US GAAP doesn't even have a separate standard for it. Finally, when it comes to leases, IFRS 16 simplifies things with a single lessee model, whereas US GAAP's ASC 842 opts for a much more complex dual model.
Section 4. Liabilities and future risks. Handling the unknown.
And this brilliantly illustrates how we shift our focus down the balance sheet. How do these two languages handle the unknown future? Look at contingent liabilities. US GAAP makes you wait until a risk is probable before you recognize it. IFRS triggers recognition much sooner, at a threshold of just more likely than not. We see a similar gap with deferred taxes. US GAAP requires a complex valuation allowance, which is basically a reserve against tax assets you might not end up using, while IFRS simply relies on a probable criterion. The bottom line? IFRS will generally force a company to recognize a risk a lot faster than US GAAP will.
We also see a really distinct difference in provisions discounting, which is basically adjusting future liabilities for the time value of money. Under US GAAP, discounting provisions is generally a hard no, but under IFRS, if the provision is material, discounting is explicitly required. IFRS forces companies to rigorously account for inflation and time, adding an extra layer of financial math the GAAP generally bypasses. Section 5. Making the global transition, bringing the rules together.
So how do huge global conglomerates actually bring all this data together? Well, to understand corporate consolidation, we first have to understand a uniquely US GAAP concept, the VIE, or Variable Interest Entity. Put simply, this is a structure where a company has a controlling financial interest in another entity, even if they don't actually hold the majority of the voting rights. It's all about who actually holds the financial risk and reward. Keep that in mind for this next slide.
Because when a parent company is trying to consolidate its subsidiaries into one massive financial report, the models really diverge here. US GAAP relies on this complex, dual-layered approach. It uses both a traditional voting model and that VIE model we just defined. IFRS, on the other hand, just strips away that complexity completely. It uses one single control model to determine if an entity should be consolidated.
Finally, what happens when a company actually wants to switch languages? Let's say an emerging global company decides to make the leap to IFRS for the first time. Well, IFRS explicitly gives you a roadmap for this with a dedicated standard called IFRS 1. US GAAP? There is absolutely no dedicated standard for first-time adoption. IFRS anticipates companies joining its framework. GAAP simply expects you to already be there.
So the crucial point is this. We are living in a fundamentally bilingual financial world. Sure, the ultimate dream for regulators is a single, perfectly converged global standard, but let's be real, we just aren't there yet. The major differences in inventory write-downs, development costs, asset revaluations, and liability thresholds mean that fluently translating between US GAAP and IFRS isn't just some academic exercise. It's a vital skill for truly understanding global market valuations.
Which leaves us pondering this big question about the future of international business. We've seen convergence in areas like revenue recognition, sure, but deep philosophical divisions really remain in how we value assets and risk. If money is the ultimate universal connector, the thing that literally makes the world go round, will the financial world ever truly speak just one language? Or are these two dialects permanently etched into the global economy? Thanks for joining me on this explainer, and as always, keep questioning the numbers you see.